Let us see a question with which we are going to have understanding of the concepts along with the understanding the numericals also. X Limited is issuing a security in form of debenture. You don't have to write anything. I just have to give explanation to you initial. Face value of the same is rupees 1000. Rate of interest offered is 14%. It is issued for a time period of, highlight the portion, only 1 year. It is issued at a discount of 5%. It will be redeemed at a premium of 15%. Investors' required rate of return is 25%. Whether security should be purchased by an investor in a way that say we are required to take a decision that whether an investor should buy the security or not. Please go through the question. Let us have understanding that's over here how to take decision whether to buy the security or not. There are multiple methods by which you can take decision. Since these are the initial questions, so I would be doing answer by all the methods. First is a very simple method in which what you can do, you can make the calculation of the NPV, net present value, from an investor point of view if investor is purchasing the security. We know that say for NPV calculation, we have to project the future cash flows and then it is supposed to be discounted in present value term for the purpose of say making calculation of the present value of the cash inflow with which NPV can be calculated. See, information is provided over here that the security is issued for a time period of 1 year. You don't have to write anything. Let me explain you. So we understand that say in year 1, what investor is going to receive? Investor is going to receive interest at the rate of 14%. So what will happen, dear students? It is 1000 into 14%. This is the interest income that investor is going to receive plus redemption value of the security. It has been given that say the security is going to be redeemed at 15% premium. So what will happen? It is 1000 plus 15%. That comes to 1150. So 1150 plus 140. That comes to 1290. This is the cash inflow from investor point of view if investor is purchasing the security today. He requires return at the rate of 25%. So at the rate of 25%, it will be discounted in present value term. 25% first year factor is 80 paise and present value of the cash inflow. That is 1290 into 0.8. So it is 1290 into 0.8. That comes to 1032. So this is the present value of the cash inflow. Whatever the present value of the cash inflow that we have, from that investment would be deducted. It has been given, friends, that the security is issued at a discount at the rate of 5%. It is issued at a discount of 5%. So it is 1000 minus 5%. So the investment is supposed to be made of 950. So 1032 minus 950. So NPV is rupees 82. That is the way the NPV can be calculated, and we can say that say from the decision making point of view, as NPV is positive, so the security should be purchased. There are other methods of the decision making also, but this is the first simple method that we have for the decision making. So this is the first method of the decision making NPV. Let me explain you further. The second method is that say you can make the computation of what is the maximum price that you are ready to pay to buy the security. That is what we understand is also given a technical name as an intrinsic value of the security. Intrinsic value, or we understand fundamental price of the security. And that is nothing else but the present value of the cash inflow. which is 1032 in our example. So as an investor, we are ready to pay maximum 1032. What is the current price? Current price is only 950. So the decision making is like this: 950 is less than 1032, so buy security. That is the way you can take the decision. Means the security price is less than what it should have been. Uh, we can say it is undervalued, so we should buy the security. This is the second method of the decision making. The last method by which, say, you can take a decision is you can make the calculation of that what is the return that the security is able to generate. You can make the calculation of the return to investor if investor will buy the security, and whatever the return that say you are able to get, that will be compared with the cost of capital 25% to decide whether to buy the security or not. Can you write in the chat box that from an investor point of view, what would be the return if investor is purchasing the security? Return answer is supposed to be given in percentage term. Dear students, over here the time period of investment is just 1 year. So we can say that the return can be calculated as interest income plus redemption value minus purchase price whole divided by purchase price into 100. See, logic is very simple. 140 is your interest income. Redemption value is rupees 1150. The security must have been purchased at 950 divided by again 950 into 100 for getting answer in percentage term. This is the way we can make the calculation of 200 rupees as the change in the price, and 140 is, we understand that, say, the interest income. That is the way the total return can be calculated. So it is 140 plus 200, that comes to 340. So 340 is what you are able to get. The same would be divided with, say, the price at which you have purchased the security. Security is purchased at the rate of 950 into 100 for getting answer in percentage term, and that comes to 35.79%. What we can do, we can take the decision based on this, that the return is 35.79%. It is exceeding the cost of capital of like 25%. So investor should buy the security. So write down answer of the question. First point, in order to take decision from an investor point of view, comma, we can use one of the following methods. NPV, fundamental / equilibrium / maximum price that investor is ready to pay. Third, return to investor. So these are the three methods by which you can do, that is, say, take the decision. Second point, if any clarification is made, comma, we have to follow that method specifically, otherwise we can calculate answer by any of the methods. By any of the method. Full stop. Friends, initially I would like to solve the questions by all the three methods. Once I cover all the variety kind of questions, not all but the basic variety questions, I would go with only one method. But initially I would like to go with all the three methods. So I request all of you to write answer by all the three methods. Because basically when the advanced questions comes at that time, unless we have done all the three methods properly, it will be difficult for a student to understand, let's say, which method is supposed to be applied or what kind of information is there. In those questions, I'll be able to give you better explanation if we have done these basic questions properly. So I request all of you to write answer by all the three methods in the initial questions. Not every time I will insist. Write an answer. NPV. Year 1 interest income. So it is 1000 into 14%, 140. Redemption value 1000 plus 1000 into 15%, 1150. Net cash flow 1290. Discounting at 25%. First year factor is 80 paise. 1 divided by 1.25 raised to 1. Present value 1032. So we understand that it is present value of the cash inflow. Investment 950. 1000 minus 5%. NPV is 82. That is the way the NPV can be calculated. Please write an answer. Write down with paragraph decision. As NPV is positive, comma, buy security. Now write down method number 2. Maximum price that investor is ready to pay, comma, to buy security. So in that we understand rupees 1032, that is this value what we have calculated, exceeds rupees 950. So buy security. So the process of calculating 1032 is same. So I'm not dictating that again. I'm just dictating to you that say if at all we do answer with present value cash flow method, maximum price that you're ready to pay method, then in that case this is the way you're required to present the answer. Method number 3, return in that write down interest income plus redemption value minus purchase price, whole divided by purchase price into 100 for getting answer in percentage term. The interest income is 140. Redemption value is say rupees 1150. Purchase price is 950. Whole divided by 950 into 100. So it is 200 plus 140, that comes to 340 divided by 950 into 100, that comes to 35.79%. So we understand that say the actual return is 35.79% and that exceeds the minimum required rate of return, that is 25%. So security should be purchased. That is the way we are required to write answer. So return decision. Actual return is 35.79%, comma, it exceeds minimum required rate of return, %25%. So buy security. And dear students, remember that all the methods will lead to the same decision. There will never be any point that say there will be internal conflict among these decisions. Always these decisions, these methods are going to give you say the same decision, never a different decision. This is method number 1, NPV. So this is the way we can do NPV or present value of the cash inflow or return, and based on that the decision can be taken.